And now, without any further delay, let's begin today's event. Once again, paying for employee expenses. Are your policies in compliance? At this time, I would like to introduce Gary Bossert. Gary, the floor is now yours.
Thank you, Christina. I appreciate that. And good morning, and thank you for attending another NCMS Plan Employment Law webinar. This is one of a quarterly series of webinars we present exclusively to NCMS plan practices. We select topics not specifically related to employee benefits, yet relevant to your work. I know that you fill many roles in your practice, and titles can vary, but one thing is common. You have some responsibility for the management of the staff in your practice and the policies in place. As a manager, you know more than anyone how important it is to stay on top of your business finances. In a competitive healthcare industry, you have to keep an eye on profit and loss, which is particularly stressful when it's your practice's money on the line, which is why terms like expense reimbursement policy can make some of you cringe. More people having the ability to spend the practice's money, that sounds like more work and more potential for misspent money. But if you manage it correctly, a good policy can actually reduce your workload and stress levels. An expense policy has two main functions: providing clarity on expenses and avoiding unnecessary company spending. In other words, how much are you spending and how are you spending it? The main ways to avoid this are by keeping thorough records and being careful to understand what's a business expense versus something that could be categorized as employee compensation. Maximizing tax deductions is 101 for any business, but to get savings, you have to make sure you're not accidentally pulling a fast one on the IRS. I cannot emphasize this enough. You do not want to get in trouble with the IRS. Educating your physicians and employees is important too. If they don't know the policy, they won't be good at following it, which means you are responsible for their education. We are fortunate to have Ann Murray and Lauren Nations from the law firm Nelson Mullins with us today to discuss how practices should handle these policies. Ann is a partner in Nelson Mullins' Atlanta office, where she practices in the areas of employee benefits and executive compensation. She is a member of her firm's healthcare team, which focuses on providing comprehensive services to hospitals, physician practices, and other healthcare providers. Ann assists her clients with all types of HR and benefits-related matters, including those relating to qualified retirement plans and health benefits. She is a regular speaker and writer on various topics, including the ACA, HIPAA, data breaches, and on-site clinics. Lauren is a member of the Nelson Mullins' tax and benefits team and assists clients with all types of employee benefits, executive compensation, and employee law matters. Prior to earning her law degree, Lauren worked as an HR professional, which allows her to better understand the challenges faced by clients in dealing with employment and benefit issues. Thank you, Ann and Lauren. The line is yours.
Thanks, Gary. This is Ann Murray, and welcome, everyone. I think Gary did a great job of providing an overview of why it's important to make sure that your employee policies are, being properly run and that you're handling expenses in the correct manner. I mean, as Gary highlighted, you always need to start in analyzing any kind of employee expense reimbursement with the thought that, okay, most of these expenses, if I don't find some exclusion, are treated as compensation, meaning that they're going to need to be reported, in your Box 1 wages, and you're going to need to deal with both income tax and employment tax withholding, which we'll get into that a bit later, but can get a little more complicated. And what's really also important and not to lose sight of is if you're dealing with fringe benefits or employee expenses that are taxable to the employee, if you don't properly document them, and if they might carry over from year to year, such as a moving expense that you give someone that, hey, between now and a year and a half from now, as you move, we'll reimburse things, those can actually trigger what we call Section 409A, which are some deferred comp rules under the IRS, under the Internal Revenue Code. And for anyone who has dealt with Section 409A, it is sort of the bane of all of our existence. It creates an additional 20% federal tax penalty on the employee. And so whenever possible, we certainly want to avoid that, because while the penalty falls on the employee, we're already starting to see the first of the lawsuits coming from employees' plaintiffs' counsel saying, I got hit with this penalty and you, employer, should have done something to prevent it. So it's important that, I don't want to put the scare into you that these aren't huge dollars in most cases we're talking about, but I just want to make sure that it's clear that, that this is something that if you don't document it correctly, you can rack up additional charges. When you're thinking about these employee expenses and we talk about what becomes taxable, it's important to keep in mind that generally the amount that's included in someone's gross income is going to be based on the fair market value of the benefit that's received. So the idea being, what would a third party pay for it? Not what was the cost to your company of providing the benefit. And then we're going to go through and talk about all the different ways that some of these benefits might be taxable and might need to be reflected in your payroll system. For instance, let's say that there's certain fringe benefits or employee expenses or tools that you may provide that are going to be fully taxable immediately, and then there's some that are going to be taxable, but the employee has the ability to take a deduction or partially offset that income. And then there's others that are completely excludable from gross income, a qualified transportation fringe benefit like parking. And then there's others that are excludable, but only if you satisfy certain what they call accountable plan rules, meaning did you properly have it substantiated, and so the idea there being, did someone submit it for reimbursement with proof that they had, that they had incurred the cost? All of those things affect how these benefits are taxable and when they're taxable. On a side note, we don't address frequent flyer miles in this discussion, but it's certainly one of those things that comes up for HR professionals a lot. If you think about it, somebody can really, for any of us that have had the Million Miler Club relatives or friends or maybe some of your employees, that can be a valuable benefit to that person. What you should know is the IRS has kind of acknowledged that this is a practice that, the fact that employees can rack up all these points on something that the business might be paying for is, it brings up numerous issues under the fringe benefit rules, but basically what the IRS has said is, hey, at this point, we're not quite sure how to deal with it, and we're not going to assert any kind of tax requirement or a duty on you in HR to start, accruing this or reporting it as taxable. But this sort of non-recognition policy that the IRS has put out, they've said, we may change our mind, and when we do, we'll apply anything prospectively. But if any of these points that people are racking up, if someone chooses to, let's say, or cash those in for gift cards or to use on their personal travel, that actually is that converting to a cash value actually is supposed to be taxable to that person. And that's something that, where HR has no way of tracking that, I don't think there's really a duty on your part to have to monitor it. But just know that, your employees could, if they are under audit by the IRS, could see some additional tax declared by the IRS. So for now, nothing for you to do. But if you ever get questions on that, I think it's just an interesting issue. So are you properly handling the various employee expenses that you're dealing with? We want to start with meals and entertainment because this is one of those areas that has changed just in the last 2 years. And historically, employers, especially where you needed people to be around for emergency situations or to handle phones. I mean, in the healthcare industry, let's face it, you've got a lot of those situations. You used to be able to basically deduct 100% of the cost of meals and other expenses that you had for employees. Some of that's been dialed back as a result of tax reform that was enacted in late 2017 and took effect at the beginning of 2018. And so the IRS kind of narrowed what types of meals and entertainment can be paid for by an employer. So on the slide in front of you, you'll see on the right-hand side the new post-2017 tax reform, the new federal tax rules. Basically, employers cannot take a deduction for entertainment expenses, which brings up a really interesting, I mean, some of you may have noted, I think, Lauren, you've heard from clients that have basically said they're not going out there and buying the skyboxes and the big tickets to go wine and dine, let's say a physician's practice, obviously in full compliance with all the other laws that are out there. But I think for some of you, you just may not be seeing as much of the pharmaceutical reps and the others going out there and really buying these high dollar expenses. Let's say Skybox. Mm-hmm. Yep. I mean, it used to be those were every week you had some offer of tickets. Now you may see them dial back on that because they're not getting to deduct that. Mm-hmm. So it's not worth it for them. You'll also see that and so the same applies for you. If your practice or your business is out there wining and dining folks, you can no longer deduct those types of entertainment expenses. And I think, Lauren, you and I were talking about there's a sort of some rules you have to be careful, like if there's food included.
Right, like when you go to a basketball game and you have a suite that you rent, you pay for. So oftentimes those suites include food that's provided. Make sure if you're going to do that, to be able to deduct the 50% meal expense, that you have the food cost separately itemized on your invoice so that you can still claim at least a deduction for the meal, because the IRS has said, if it's just all one cost for the rental of the suite, they're not going to let you deduct any of it. So you're missing out on getting at least the 50% meal deduction.
Yeah, so important point, and I'm sure that that's something that you would hope that everyone who provides those types of entertainment venues has moved to that. But if not, ask for it ahead of time so that if you get a separate line item for the foods, then at least you'll be able to deduct that for the business. Mm-hmm. And that brings up the point. So employers can still deduct 50% of meal expenses. And what's important to note is that includes now deduction of meals that are provided for the convenience of the employer. So if you are providing meals to your staff because you need them to be there to, maybe patients always run over during lunchtime. I mean, let's face it, that's, a common problem. There's never enough hours in the day. Or if some of them have to be on call to answer phones, then it's really important for you to realize that if you're bringing those meals in, you're now only entitled to deduct 50% of it, not 100% of it. But here's an interesting note. I mean, we're tax and benefits lawyers, so interesting, take that lightly. But, the IRS actually came out with a ruling earlier this year. It's actually a technical advice memorandum 2019-0301, where they talked about in detail what are the types of employer-provided meals for the convenience of the employer that can be reimbursed. And they sort of talked about these factors that have to be met in order, and some examples of situations or reasons you might have someone on site and require them to be on site, and whether or not that really satisfied this requirement that it has to be for the convenience. So what they said is, and here's some examples, is going through this technical advice memorandum, they said that the reasons that something is for the convenience of the employer would not include fostering collaboration and innovation. That was that didn't pass it. Protecting confidential and proprietary information. Nope. Safety concerns with the surrounding area. That one, they said, there really wasn't, it wasn't supported by employer policies and didn't really seem to rise up to that level. Providing healthy eating options. That one definitely did not pass with the IRS. where you're saying that someone cannot obtain a meal within a reasonable meal period. So, your office is located where it's too difficult for people to go out and go to a restaurant. I was going to make a comment that there wasn't a McDonald's close by, but let's not encourage, maybe combination with healthy eating options. But the IRS basically said, we're not so comfortable with that, especially, they said, nowadays, and here's what the IRS said was, while the availability of meal delivery service is not determinative in every analysis, meal delivery is one consideration that we will look at. So if there's, Uber Eats or DoorDash or Grubhub or one of these that could deliver, they're basically starting to look at that and say, you can't tell me that the fact that there's no restaurants close to your office somehow, makes this, should make your meals deductible. And going on our example, short meal breaks due to work demands. Now, that one is supportable, and I think that's one of the most common that's going to fit for a medical type of office or business. But you need to have, policies in place, and it's not an across-the-board thing. You can't that doesn't necessarily mean that someone who's a back office worker is going to fit that exclusion, whereas maybe a nurse who needs to be there or a physician might. And then definitely availability to handle emergencies. Someone who sort of needs to be on call at all times, that definitely meets the exclusion. But here's what's interesting is now that these rules have changed to where only 50% of the cost is reimbursable, what the IRS has made clear is that, you know what, we think that meals are limited, but we don't think snacks are meals. And so, from an HR and business perspective, the basic idea here or differentiation is you can have all the snacks, coffee, donuts, chips, whatever in your, kitchen area, and those can be free to employees and they will be non-taxable, versus, and we all have lived off the vending machine at one time or another, versus if you provide the meal, you've got to meet all these convenience of employer requirements. Yeah. So it's just something to think about, on what your policies are. What I do recommend is whatever your policy is, you need to make sure that it's properly documented. If you have a policy where you're requiring, or if you are providing employer-provided meals, you should have a policy in place that says, we provide meals, this is the group, here's why we're doing it, here's sort of build your case for why these are a business, for the convenience of the employer. So if you have the opportunity in the near future, revisit your meals and entertainment policies. Make sure if you're reimbursing entertainment expenses for some of your people, you may want to limit that now that it's not deductible. You may want to limit or require that, like Lauren was saying, that they break out those meal costs separate from whatever the entertainment is, and kind of try to maximize your dollars there.
Yeah. And the IRS has even put a little bit more restriction on, what meal expenses can be deducted for that 50%. I mean, if it's something that's what they say lavish or extravagant, they're not going to allow that to be deductible. Yeah, and that'd be like a big steak dinner,
And that's a good point, because for all of you that, we are dealing with a lot of medical practices and
taste for fine food.
So yeah, taste. We won't limit who likes that fine food, but I think that is a risk. Okay, moving to our next subject, it's education expenses. Let's face it, in the medical field, it's all about continuing education, right? And Lauren, you want to take this first one, or you want me to address that? And
you can take that one.
Okay. On the first, talking about education expenses, we've got different categories, and it really depends on what kind of expenses are you looking to reimburse for your employees. Continuing medical education, CME expenses, I think that's a given for most practices, especially in this tighter labor market. It's tough out there. The requirements are that your CME expenses, it has to be work-related educational expenses, and those are non-taxable to the employee and deductible by the business in full, as long as it maintains or improves the employee's job skills, or a law requires that continuing medical education to keep the employee's status or occupation. So, look at both of those and make sure that your policies are clear that those are required. Also, what's important is when we talk about all these different expense arrangements, you need to make sure that you are requiring that the employee provide information about the date the expense was incurred, the amount of the expense, what it was for, and if there is any question about its link to your business, sort of why it's connected to your business. I recommend on the employer side that you have some type of reimbursement form and you keep the copies of what the employee gives you. You can require that the employee retain those copies, but when it comes down to it, if you're audited, you're going to be the one that has to show and provide the proof on why you could take that deduction. And trying to rely on the employee to be able to, they may not even be employed by you down the road. So I think it's better that, and nowadays, most of the HRIS type systems have got expense reimbursement programs and everything. If you don't, and if you're a smaller office, then at least just scan it in and retain those copies. I think that's important. A minimum of 3 years after you've filed your business tax return. Ideally, we would rather see you keep it 6 or 7 years, just because that's kind of your maximum look back if they were somehow, the IRS, was somehow trying to assert a substantial understatement of taxes. So CME expenses, I think that's the most common. But for a lot of you who might be looking to entice or recruit, let's face it, the nursing market is always a challenge and a struggle to both recruit and retain. You may already have in place some sort of undergrad or grad degree program reimbursement. If you don't already have that in place, or you have it in place but it isn't really formalized, we encourage you to think about adopting what we call an educational assistance program, because you can reimburse up to $5,250 per year per employee, tax-free, as long as it's for either an undergraduate or degree program, and the program, and you satisfy the written plan requirements and some of the other requirements that we're going to talk about here on the next slide. So, basically, we look at it and we say, I should have forwarded it to that slide last. So my apologies. You'll get that slide quick. But on the educational assistance programs, basically it's undergrad or graduate. It does not, in this case, have to be work-related. Now, you can choose to require that it's work-related. So, it kind of depends on how you feel. Some people, I've heard from clients, hey, we'll do anything to attract people, and if it means that we get someone for a limited number of years and maybe we help pay for them to basically go get a degree where they go work in some other industry, we're willing to do that. On the other hand, you may take the view, no, okay, I'm going to put in place this written policy, and we're not talking about it's not like your 401k plan that's some big plan. We're talking about a couple-page written policy. Most of them that I see are not more than 2 or 3 pages. And you could choose, if you wanted to say, okay, we'll pay for undergrad or grad, but it has to be, in the medical-related field. It could be maybe it's a lab tech, maybe it's nursing, maybe it's maybe it's even going and getting their, MD's degree or something similar. But you need to make sure that that's clear in your written document. And here's the key. If you do that and you limit it so that it is work-related, make sure that that you think about the non-discrimination rules. Because if you were to restrict so that you were only paying for something like going and getting your MD.
Right, graduate.
Well, who is that really benefiting? Right. Is that necessarily benefiting your lower paid employees, or is that going to be something that someone might be able to argue, well, this is kind of skewed unfairly in favor of our, physician group. So you don't want something like that, and you don't want to deal with those issues. So make sure it's across the board. Also, when we talk about the kinds of educational assistance benefits your program can reimburse, make sure that you've got your payroll systems or your tracking systems set up so you're only reimbursing tuition, fees, and supplies and equipment. You're not reimbursing things like, when we talk about supplies and equipment, we're talking about supplies and equipment that the employee does not retain.
So not like a laptop that they bought, that they
now,
can keep
if they
the
turn the laptop back into you, that can be fine. But you can't you can't pay for the laptop and then have them keep it. Textbooks are the one exception here.
Because you can never resell those anyway.
Nobody wants a textbook.
We all been there. Can't get rid of it.
So they can keep the textbook. But they cannot get meals, lodging, transportation. You'll see that on the slide in front of you. But anyways, the educational assistance program, if you don't already have one in place, it is fully deductible from the employer side, and it's non-taxable to the employee. If you do already have one in place, make sure that these are expenses that are being deducted and being tracked properly.
And the type of reimbursement you give them could take, several forms. You could reimburse them for expenses that they have already paid or incurred, or you could directly make payments, for example, to their college or, university that offers the course. Educational assistance programs also seem to cover any on-site training that you give your own employees for free.
Yeah, that's a good point, too. If you bring people in to provide certain CME or other education for your employees, yes, that's definitely something that can be included here. Okay, uniforms. We all know the issues that these can bring. So, Lauren, I think you're going to take this one.
Sure, yeah. So basically, as we have here on the slide, there's certain rules that you have to meet to be able to get this excludable from the employee's income. Basically, the first one is that the uniform or the workwear or the outfit is specifically required to be worn as a condition of employment. And it also has to be of a type that's not adaptable to be what they call streetwear. So those seem pretty self-explanatory, but we'll go ahead and go through them. For the condition of employment rule, basically it's that your employer has required you to get this uniform. Just because that clothing may be useful to perform your job, such as, my mother is a nurse. She has always worn scrubs, whether it was required or not, because it's just, if you get it dirty, you take it home and wash it. It's got all the pockets everywhere, somewhere to put your badge. But if your employer doesn't actually require you to wear those scrubs, for example, it wouldn't be excludable.
So it's important from that end that you have included in your employee handbook or in your HR policies that you require that folks wear, let's say it's nurses wearing scrubs. If that's a requirement, then you need to make sure that your written policies don't allow them to come in other casual wear.
Right. Some of the equipment that they may wear isn't necessarily required to be required by the employer for it to be excludable, such as hard hats and safety shoes and safety goggles. That'll still be excludable. Also, regarding the streetwear requirement, there has to be something about the piece of clothing that makes it inherently unsuitable for everyday wear. So, again, going back to the scrubs example, again, my mom had those scrub pants on all the time.
I was going to say there's
you know?
definitely an argument that scrubs are streetwear in some sense, because you see plenty of people out there.
Yes.
But no, I think that they
And again,
despite that, would still satisfy.
It would be unlikely that I think the IRS would ever come after someone for, claiming money that they got reimbursed for, having these scrub pants on. But just, be aware that it could be something that happens. And when the IRS looks at whether it's suitable or unsuitable for everyday use, they determine that objectively. So just because someone, their lifestyle may not, they look at the reasonable person. They don't say, well, is that normally something she would wear in her day-to-day use? That doesn't really matter to the IRS. They've also said that just because it has your logo, like the hospital logo or the medical practice logo or the employee's name on it, it could still be streetwear. The IRS reasons that a lot of clothing now has commercial logos on it, and just because it has the logos doesn't exempt it from being streetwear.
Now, what about cleaning expenses? Like, as a medical practice, if let's say I offer cleaning or a laundry service as part of two employees for their outfits, or I reimburse them, is that taxable, non-taxable?
As long as the clothing itself, that's what the IRS looks at, is the clothing excludable, then anything to clean or launder that clothing would also be excludable, whether it's done on site or a reimbursement.
Okay. And once again, that should be included in your policies.
Right.
So that it limits, basically your policy should say, we only pay for or reimburse, or we only provide this service, don't throw your sheets in here.
Yeah. Yeah. Make sure everything's itemized on the receipt if they have that. That's a good point, Ann. And along that same line with medical instrument expenses, basically, if there's certain, what we put here on this slide are things that will, if those facts are present, the IRS says it can't be excluded. So if you have an arrangement where you reimburse your employees for medical instruments, regardless of whether they actually incur that expense, the IRS is going to say that's a form of wage recharacterization, and it should be included in their income.
So in that example, you're talking about if you basically are saying, we give you $100 a year for your, well, actually that would be a really cheap stethoscope.
Right.
But, let's say that it's $500 a year and you're not requiring the substantiation.
Right, exactly, because they're saying that doesn't meet what the IRS calls the business connection requirement. I mean, you're just giving them this money and you're not making sure that it's connected to your business.
Got it. I always call that one the Bubba wants to buy a boat. But
that's not connected?
If someone gets the money and they can go out and buy a boat with it. Now, granted, our $100 or $500, I don't know what kind of boat we're buying, but, that's what I always think of mentally.
Maybe a kayak.
If Bubba can buy a boat, then it's taxable.
Right. And along that same line, if you're reimbursing them for expenses they incurred while they were employed by another employer, that's also not going to be excludable because it wasn't in connection with your business.
Oh, that's a good point. So if you're using that as a recruiting tool, or someone hasn't completed their, and that even goes to the educational expenses. If you're saying to someone, hey, come over here and work for us, and we'll pay off that educational loan that you have, or pay for whatever that tool, the stethoscope that you just bought, if it was incurred when they weren't with you, then that's going to be taxable.
Yeah.
Huh. I mean, it would be interesting for them to track that. But
again, you wouldn't think that they would
we're
really
giving you what the exact rules are.
Right, just in case, FYI. Also, they have to be substantiated, like Ann was talking about earlier, for your education expenses or your CME. Basically, they have to have something on the invoice or the documentation to show that that expense is attributable to your business. Instead of sometimes you get a receipt and it's just got a dollar amount, doesn't say what it's for. You want to be able to show, okay, a stethoscope, $500 on January 1st. Something at least describing what it is that they could then look at your job and say.
And so if the receipt does not have that on it, then you need to make sure that whatever your reimbursement forms are that you're using have some descriptions and the employee is signing off on that so that you've got something retained in your record.
And maybe even better on the expense reimbursement form to put their job title or something that, just anyone coming and looking at it later would have all the information they need to be able to quickly check off, yes, this is substantial. This is attributable
right, because that's
to her
just
job.
an added step for you if you get audited down the road to suddenly say, oh, wait, who was this person?
Right.
They're not with us anymore. What did they do? Yeah. Have it all there.
Yeah. The other requirement is that the employee has to return any excess of the expenses. So that's, because again, you're not just paying them a flat amount and they don't have to pay anything back. So they want to make sure it's attributable to this tool, for example.
So your policy should, I'm taking from that if we're putting in place a policy, it should clearly state that if they had to return the item or they got a discount back on the item, that they have to return that money to the company.
Right. Yeah, you generally only see that come up if you advance expenses, not necessarily if you are paying them after the fact. And as far as when should they return this excess, it's that reasonable time, and the IRS has defined that as generally within 60 days of when they've incurred the expense or gotten the excess.
But I think that does come up where and it's one of those things, I don't even know that it's been in every policy I've drafted, but I think it would be a good idea to have that extra, just a sentence in there that says, if the item that we've reimbursed is returned and you receive money back, you must turn that back into us within 30 or 60 days.
Yeah, exactly. Because that way you've already, in your policy, you can just provide that to the IRS if they ever come knocking and you've already checked off all the boxes.
Okay. And
again, like Ann was saying, keep copies of the substantiation that they give you, all the documents that substantiate the expense. And this, your medical instrument expense reimbursement, you can either, again, reimburse them with with a reimbursement check, or it also applies when you allow them to use the company credit card.
Okay.
So.
Moving expenses. Here's another subject that we've seen some changes in. Historically, you could, for those of you that have, especially if you're trying to attract nursing or physician staff or even up at the executive level, paying for someone's move in order to entice them to relocate to your area has always been a valuable recruiting tool. The rules really changed with the 2017 Tax Act. So beginning in 2018, employers can no longer, if you reimburse someone for their moving expenses, or if you pay those expenses directly to Allied or one of those moving companies, two guys will move you, one of those, you can no longer deduct those reimbursements. And those reimbursements or direct payments have to be included in the employee's income as imputed taxes. So this is, used to be the trick of whether you reimbursed versus whether you paid direct. And there were all these companies out there, and I don't know what these relocation companies did to really tick off the current administration, but I've been talking about killing a lot of their business in one fell swoop. So look back. If you have old policies in place that you're pulling out when you're making new job offers to whether it's executives or whoever, and you're putting in your stock language that predates this Tax Act, go back and revisit it, because while, first off, you don't want to be making a representation in your offer letters or in your materials about the taxability of these benefits. You don't want someone, even if they may not have a legal claim against you, you don't want to tick them off on their way in and have them not understand how these things are provided. But you also should be aware that, the fact is, if you want the right talent, you're still going to have to pay to move people.
Yeah.
But now the question is, should you simplify this for yourself? I mean, is it better to just say, hey, here's $10,000, and going back to my example, if Bubba wants to buy a boat, he can do it if it costs him less, and it's all just taxable to the person. For a lot of employees, I've found they're just fine with that. They would rather have the freedom to then go out and save a dime here and there and maybe pocket some of the money, and they don't really care that it's taxable. On the other hand, maybe for some of your higher level people, what you need to think about is fine, we'll reimburse exactly what it costs you, but maybe you want to add in some gross up for taxes. You know, I strongly recommend, if you are going to gross your employees up for taxes, meaning, you know, if you give them if you say I'll reimburse up to $10,000 of your expenses, then make sure that if you're saying, and I will cover your taxes, it's much better to say, I'll cover your estimated taxes based on, you know, the highest rate in the federal and state, and say you'll do it one time, meaning if you pay $10,000, you calculate $10,000 based on the highest federal tax rate and state tax rate, and you pay it once. They'll owe taxes on that gross up you provided them, but that's kind of their problem at that point. If you get into what they call these circular gross ups, it takes on a life of its own. It's going to more than double your cost, your out-of-pocket cost for this benefit, and it just becomes very difficult to administer. Similar to if you say, I will pay your exact taxes. You know, then you've got to wait till they file their tax return, and then they're coming back to you with a, well, you know, I got an adjustment or I missed this deduction, and it takes on, like I said, a life of its own. So I think it's better to just make sure that your policies, or if you have standard language that you put in your offer letters, make sure that it's just straight to the point. You know, we'll reimburse up to this estimate, and then we will pay, you know, cover your estimated taxes one time, and then it's your responsibility. Or, going back to our point, keep it really simple and just say, here's $10,000 for moving expenses. You are responsible for the taxes.
And because there's generally no deduction, there's really no non-discrimination requirement? Like, are you allowed to do that with your higher-level executive?
Yes, you don't have to be fair or equitable among, if you only reimburse moving expenses for your physicians and not your nurses or other staff, that is totally fine. There's nothing that you need to worry about there. Note that this also, these changes in the tax laws also actually impact reimbursement of mileage in connection with a move. You know, I think for a lot of people, because you're used to when you're dealing with normal business expense policies or maybe entertainment, you know, all of that, you normally reimburse mileage. I mean, I don't remember the current mileage rate, but, you know, whatever, 58 cents a mile. And so I think the tendency for a lot of HR professionals is to just automatically reimburse mileage when someone's moving. But no, that was also taken out. So, yeah, you're kind of stuck if you're relocating. And it's just one of those areas that can be difficult. Also, I brought up 409A at the beginning of this, which I was saying is a tax code section that can make our lives difficult. What's really important when we talk about these moving expenses is you need to make sure that your moving expense policy is, as we said earlier, in writing, but also don't have your moving expense policy span years, if at all possible. And if it does span years, then it's better to break it up so that any expense has to be paid and reimbursed by March 15th of the following calendar year. Otherwise, you can potentially run afoul of this code section 409A. And like I said, the last thing you want to do is tick off some very difficult to recruit physician coming in when he gets nailed with a 20% tax penalty on what you paid him to come to your practice.
And we often see those clauses in the employment agreement. And where, you know, for the expense reimbursement.
It's one of those offer letter things that's very commonly overlooked and can create issues. Okay, transportation expenses. I would say most businesses, I mean, wouldn't you find, Lauren, most of your clients nowadays are reimbursing parking. I think parking is almost a given for a lot, especially those that are in cities and dealing with, you know, the higher parking expenses that come with it. But for a lot of employers, you know, they expanded to things like buses, train passes, It might be whether it's a train or it's a shuttle bus. A lot of metropolitan areas, folks take the shuttle bus into work, and bicycle commuting. So those tax rules also changed as part of the 2017 tax reform. So not only did they not like moving relocation companies, but apparently, and in particular, apparently they did not like bicycles. So just remember that. So the new federal tax rules beginning in 2018 are that all of these different reimbursements of transportation expenses are not deductible by the employer unless they're necessary to ensure safety of the employee, and that is a really narrow exception. If you're trying to rely on that, make sure you're working with your accountants or tax advisors and that you feel comfortable you really fit in there. So if you reimburse parking, bus passes, shuttle buses, make sure you're no longer tracking that and reporting it as a deductible expense. Now, as far as the employee side of it, the employee still is not taxed on that. So, it's still a valuable benefit that you can provide to your employees. But, except, and I said they didn't like bicycles. I don't know why, but if you reimburse bicycle commuting, that is taxable to your employees beginning in 2018.
Like the cost of a bike, or I don't know. What cost you would incur with your bike service.
I know, but it is one of those things that I don't know why they singled that out, but this is, and by the way, this is for tax years 2018 to 2025. We're not sure what's going to happen after 2025, but we can all be assured there will be changes. Yeah, there will certainly be changes between now and then. And one thing that is interesting, though, is if it is really important to you to get the deduction for, these can be sizable expenses depending on how many employees you have. You can actually run them through a cafeteria plan, and that will allow you to get both a deduction and to prevent them from being taxable to your employees, except for the bicycles. And so that's just a possible avenue if you have not already considered that. But also a related thing, things to consider that are related to this rule is, and I don't necessarily know a clear answer to this, but what if your office lease includes free or discounted parking? So you have an office lease and it gives you 10 free spots. Does that make part of your office lease not deductible by you? So going with kind of similar to where we were talking about the skybox, and if you had food there, and you lost your deduction, if you have the parking, do you need to break it out? Are you safer breaking, possibly having them say X amount of your lease is attributable to, these free parking spaces? It's something that you may want to talk through with your CPA, because I think that's something that falls more into what is your CPA going to require for his or her comfort to allow you to continue to take this deduction. There's also something called a Qualified Transportation Compensation Reduction Plan, which is a not very commonly used program, but it's certainly something that can allow you to still take a deduction for some of these expenses. We did have a couple of Q&As come in on, or we had the Qs come in on transportation expenses. We're supposed to do the A's. And the question came in on transportation expense. If an employee is traveling and paying to park at a hotel, is that reimbursable to the employer? And that's a good point. So when we talk about these transportation expenses here, we're talking about the commute. So this is where you are helping your employee with their commute. This is totally different than the normal, what we call 162M employee business expenses. If your employee is traveling on business and you are reimbursing mileage or parking at the hotel, then that continues to still be fully deductible and non-taxable to the employee. So no worries there. And another question came in along the same lines. So assuming that the parking reimbursement for business travel is distinct from parking reimbursement for at the office? Yes. And then finally, the question is if this is going back to the tuition educational assistance. If the continuing medical education, CME, is both a graduate degree and maintains and improves skills, if it's more than $5,250, can the rest be considered CME versus, so let's say you have someone that is running their expenses through your educational assistance plan or policy. So you have a tuition reimbursement or educational assistance policy, and it's an undergraduate or graduate degree program. You can reimburse $5,250 non-taxable through that. Mm-hmm. But yes, as to anything else, if it is something that is done, it has the sufficient connection to your business and falls within that business expense category, so it's tied to, then it's sure you can reimburse it. It is, you're not, just because you put part of it under the educational assistance policy does not mean that the excess, that you can stack your exceptions. And I think that's a great question. Yeah, because I hadn't thought about it, but
and those courses do get very expensive, so you could quickly get over the $5,250.
Yeah. So for example, if the employee is reimbursed $6,000 for a graduate degree, $5,250 would go under your educational assistance program or tuition reimbursement policy, and that's assuming you've met all. Right. It's a qualifying policy, and the additional $750 would be reimbursed just pursuant to your reimbursement policies for continuing ed, and that would work fine. That is totally non-taxable to your employee and deductible by you. And along those lines, what you may want to make clear in your CME policy would be, hey, this would, to the extent that something is not covered by our educational assistance, if it is sufficiently related, we'll pay for it here. Or you might put a note in your tuition reimbursement policy to make that clear. You don't have to. I mean, that's not like it's not like you're not going to be able to claim that because it wasn't written in your policy, but it's just it might make it clear to everybody.
Yeah, at least your employees will know.
Yeah.
Because that's a good question.
Exactly. Okay, enough about, I was going to say enough about planes, trains, and automobiles, but we got one more, car expenses. So some of you, especially if you're in a smaller practice, will see this you may have, physician owners and you're reimbursing their, they may have a company car, or you may have, it depends on how your business works. I mean, you may have folks that are out there in the field who, you give them a car allowance or you reimburse their car expenses. It's important to know sort of what the different tax impacts are here. The cost for a company car, the cost may be deductible by the employer, but what you have to basically figure out is, okay, what portion of this is being used for business expenses versus non-business expenses? And the portion of the company car that's used for non-business expenses, unless it's something really small, incidental, that has to be taxed to the employee. So, that's something that for a lot of businesses, that's just too much hassle to be tracking. It's not unusual, I'll admit, to see folks take the view that, hey, we don't have to claim any of that. Mm-hmm. But it does, put the employee at risk. Note that if you are providing the company car, proper valuation of that is really important. And like I said, allocating it. You have to report that value. You're supposed to be reporting it both for income and employment taxes. You're supposed to be filling in basically, it's box 1 on the Form W-2. You've got to include it in Social Security and Medicare wages. Now, to the extent that something's taxable, a company car that you're providing, while you have to withhold Social Security and Medicare taxes on the value of that benefit, note that you actually don't have to withhold income taxes if you if you don't want to, or it just works better for you. The trick, though, is that if you as the company don't want to have to basically, because the reason here is, so you give this company car benefit, and then you go over and you have to deduct it from their other wages because it's a company car, so you got to get the cash from somewhere. That can make an employee very unhappy, and depending on the employee, can make them very vocal. So if you don't want to have to deduct income taxes, you can actually opt not to. But if you want to do that, then you have to provide a notice to the employee in writing by January 31 of the election year, or 30 days after the date the vehicle's first provided to the employee. You can withdraw that election at any time, but I think that's a very commonly overlooked step. Just make sure, and you may just want to, if you provide several company cars, you may just want to do that annually, is provide that election form where you notify everyone, hey, we're not going to be deducting income taxes, note, because you'll have to come up with it at the end of the year when you file your taxes. If, on the other hand, you allow some sort of car allowance, I mean, that's definitely the simplest approach, and a lot of times employees like it because, hey, they just get the cash. But going back to my Bubba wants to buy a boat, you provide a car allowance, and if someone wants to go spend it on something else, it doesn't necessarily mean that, if your concern is that they might roll in a jalopy, old crappy car, this isn't necessarily going to ensure that what they're driving is presenting the right image for your business, maybe?
Yeah.
I mean, that can... So if that's important to you, first off, make it clear in your policy. But you may want to reconsider the whole car allowance side of things. And plus, when you provide a car allowance, I think, Lauren, you've seen this on the HR side all the time. A lot of people have that entitlement mentality. And once they get used to getting that cash, it's hard to ever take it away.
Yeah.
And they forget what it was connected to.
Right.
So, yeah, you provide a car allowance of, let's say, $5,000 a year. Well, they're going to get that money. They may spend it elsewhere, but also they're going to incur taxes because the car allowance is totally taxable. So the end effect for them, you may not get as much, in a sense, bang for your buck. You may not get the connection and the feeling from the employee that they have this awesome thing that you do with a company car, or even with the car reimbursement. And then in lieu of the company car or the car reimbursement, you could do employer reimbursements for the business use of an employee's car. This one, going back to all these other expenses we've talked about, you need to make sure it's getting substantiated. So, you cannot reimburse someone's daily just transportation expenses commuting under these rules. But you can, reimburse any, going back to you tell someone to drive to their CME and or to a business meeting, and you can reimburse their expenses. And, note that when you're calculating reimbursement, one of the most common methods is to use mileage, and that's, as we talked about earlier, that's at a 58-cent per mile rate for 2019. What's weird is, by contrast, the mileage rate used for medical expense deductions is 20 cents a mile. So just in case, for any reason, someone gets those confused, remember those are different amounts, and you need to make sure that you're reimbursing those at the proper level. Right. We had a couple other questions. So a follow-up was to our earlier talk about the education expenses. Actually, let me take this one first. Both of these go back to the other. Does the employer in the policy for education have the right to choose which employees will receive that education expense? So in other words, can we limit it by position, or would the policy have to be offered to all? I believe that we do have the non-discrimination rules for the education expenses, because that kind of goes back to that graduate degree program I was talking about. Now, that still doesn't mean that your education assistance policy has to cover every single person.
Right.
What we're concerned about here is that when we look at the number of highly compensated employees, and I think for highly compensated for this year, we're looking at people that are earning above 125. So if we're looking at a highly compensated employee, do we have a similar percentage of non-highly compensated employees who participate under this program? I'm overgeneralizing here. It gets a little more technical than that, but that's the best way to think about it. So, that does not mean that you have to offer the policy to your reception staff, but you might offer it to your physicians and your nurses and your lab techs, just going if this was a medical practice.
Right.
And then the second question was, are meal expenses incurred during a CME or business trip deductible and non-taxable for the employee? Because they're connected to something that they had to do for business purposes, they are still non-taxable to the employee. However, as far as deductibility, you're still subject to the 50% deduction for the employer. So, take that into account when you're figuring out what the true cost is for you. Okay, and we're finishing up. Thank you for everyone that we have gone slightly longer than we usually do. We usually try to keep this right to 60 minutes. But gyms and athletic facilities is kind of our final topic, and it always brings up sort of interesting issues. There is a difference between on-site gyms and paying your employees for or reimbursing your employees for the cost of their gym or workout facility membership. I'll take the qualifying on-site gyms. Basically, if you are not already aware of this, if your location, if you meet certain requirements, you as an employer can exclude the cost of providing an on-site gym or other athletic facility to your employees. Basically, the whole value of the facilities gets excluded from the employee's wages, and you get a deduction. So it can be a great thing. Here's the four sort of requirements you have to satisfy, and what you'll see is this will rarely be something that you can do. Although I could see if you are you are a hospital, that definitely can be something. If you're a small medical practice, wait for Lauren to talk about reimbursing memberships. So the four requirements for an on-site facility has to be an athletic facility, and this is relatively broad, but certainly gyms are going to qualify there. It has to be located on the premises of the employer. This doesn't mean that they have to be in your office to qualify for the exclusion, but it has to be on the premises where you're located, where you either own or lease your office. So you don't have to be, on the title of where that gym is. In fact, there was one IRS ruling where, the facility was on the roof of the parking garage for where the employer and other employers were located. That was sufficient to be on the premises. So for some of you whose offices are in a larger building, you might have an on-site gym within that building. That would qualify potentially as on the premises of the employer. But here's the other kicker. So it has to be operated by the employer, and it has to be substantially all of the use has to be by employees, spouses, and dependent children of the employer. Those last two requirements is what basically does this one in for any small medical practice. If you are with a hospital or some larger business, that's where, or you're a medium-sized medical practice that has your own building and wants to put a gym in, that's something to think about. But I think the more common situation is, Lauren, is what people reimbursing.
Right, and the biggest thing to notice here is, as noted on the slide, it's not going to be deductible by the employer, and it's going to be taxable to the employees, which is unfortunate because, when you think about not just recruiting value of offering this benefit, but just the morale and health of your employees. It's a great benefit, and it's just unfortunate that it's not more tax favorable.
Well, and one thing that you could think about is if you are adopting, wellness programs have really picked up in their popularity. And one thing that I've seen people do is they've gone in and, okay, this is taxable to my employee if I reimburse them for these expenses, and I really want to encourage people to get healthy, and hey, it drives down our medical rates and all of that. So one possibility is doing a participatory wellness program. So as part of your wellness offerings, if someone joins a gym, you have a wellness perk within your coverage where you credit some of their deductible or credit some of their premium payments. So just something to think about, and I'm sure that the folks at NCMS can talk more about those types of benefits, but that's something to if it's very important to you, then that's something to just consider. And finally, for those of you, we always have to put our tax-exempt employer disclaimers in here because these tax reform rules that came out in 2017 added this whole weird differentiation with tax-exempt employers. If you are a tax-exempt employer, the 2017 Tax Act basically said, new rules apply to you if you offer qualified transportation fringes, meaning you're reimbursing the part or giving free parking, the shuttle or express bus or train, all of those things, that you can actually trigger unrelated business taxable income or taxable business income, whichever way you prefer to say it. The UBTI that everyone always dreads in the tax-exempt world, you can actually trigger UBTI for your organization if you adopt and continue to have these parking, buses, trains, planes, trains, all those sorts of things, or on-premises gyms and other athletic facilities. Those can trigger the UBTI. So if you have those in place, that's something to just talk through, I think, with your CPAs and make sure that to the extent that you need to be taxing those to your employees, that you're doing so and, avoiding, to the extent that avoids UBTI, all the better. And
there is a slight clarification on the requiring them to be taxed on the on-premises gyms. Basically, that will be triggered if the facility isn't primarily for the benefit of your employees or they find that it discriminates in favor of highly compensated employees.
No, that's good.
So if you have those exceptions, then
so going back to you can't limit your gym to just the
president.
Yeah, exactly. Well, we want to thank everyone for joining us today. I think let's see if we have any other questions. Nope. Looks like we don't have any that have come in. Gary, is there anything on your end that has come in?
No. Thank you very much. I think this has been a very interactive session. We appreciate all the questions. And Lauren and Ann, you did a great job as always. Great conversation, good information, and thank you so much.
Thank you.
Thanks, everyone, and have a great day.
Have a great day. Bye-bye.
Thank you. And once again, this does conclude today's webinar, and you are free to disconnect. Have a great day, everyone.